Namaste, learners, and welcome! Today, we're cracking open Chapter 1 of the NISM Mutual Fund Distributor Certification exam. It's called The Investment Landscape, and you can really think of this as your foundational map. Now, a lot of students try to just rote memorize this stuff, but hum waisa nahi karenge. We're not going to do that. Instead, we're going to focus on understanding the real why and how behind the concepts. Because honestly, once the logic clicks for you, the exam questions become incredibly easy. So, let's dive right in. Okay, here is our quick roadmap for today's explainer. We're going to cover financial goals and inflation, the actual difference between savings and investments, the 4 core asset classes, navigating investment risks, figuring out behavioral biases and asset allocation, and finally, the big debate, DIY versus professional help. All right, let's start with a scenario. Imagine a client walks into your office and the very first thing they ask is, hey, which is the best mutual fund scheme? It bought the common sawale, right? Almost everyone asks this exact thing when they first decide to invest. But here's the secret. It's completely the wrong first question to ask. As the leadership guru Simon Sinek brilliantly puts it, you have to start with why. Before you even think about asking where to invest, you absolutely must ask why you are investing in the first place. You see, your focus needs to be on the investor's actual needs, not just on pitching investment products. What exactly are they trying to achieve? To figure out that why, we have to set solid financial goals and prioritize them. And to do that, enter Stephen Covey's time management matrix. I want you to look specifically at Quadrant 2, important but not urgent, because this right here is where true wealth planning actually happens. Think about things like your child's higher education or your own retirement. They definitely don't scream for your attention today, right? But they are absolutely critical. If we don't start funding these responsibilities now, they're eventually going to become massive emergencies over in Quadrant 1. The trick is to categorize goals into responsibilities, dreams, and good-to-haves, and always make sure you fund those critical responsibilities first.
Now, as you start assigning rupee amounts to these future goals, you have to watch out for the single biggest trap out there, both in real life and, trust me, in your NISM exam. And that trap is inflation, or महंगाई. It's simply the steady rise in prices that slowly, silently erodes the purchasing power of your money. Think about it. If a good college degree costs 50 lakh rupees today, there is no way it's going to cost 50 lakh in 10 years. If inflation is hovering around 8%, that exact same degree might end up costing over 1 crore. Literally double. If you don't adjust your future goals to account for inflation, your entire financial plan is basically guaranteed to fail.
Just to put that into perspective, take a look at how dangerous inflation really is. If you have 10,000 rupees sitting in a drawer today, and we assume an inflation rate of 8%, after just 5 years, you would need over 14,000 rupees to buy the exact same basket of goods. And jump down to 30 years later, you'd need over 1 lakh rupees. That 10,000 is literally losing its power every single day it just sits there. You have no choice but to grow your money faster than inflation. Okay, quick mental checkpoint. Always start with the why. Be sure to separate your goals into needs, dreams, and responsibilities, and prioritize them. And for the exam, please remember this golden rule. Always, always adjust the future cost of any goal for inflation. So we know we have to beat inflation, which means we need to invest. But hold on a second. Are saving and investing actually the same thing? People use the words interchangeably all the time, but they are totally different beasts. Saving is simply reducing your consumption today to set money aside. Its main goal is pure safety. Piggy bang mein paise rakhna, that's saving. Investing, on the other hand, is taking that saved money and putting it to work for you to earn a profit, and that involves taking a calculated risk. And here's the kicker. Saving must precede investing. You literally cannot invest what you haven't saved.
So when you do finally decide to invest, how do you actually evaluate an option? Exam alert right here, guys. You need to evaluate everything based on 3 primary pillars: safety, liquidity, and returns. Safety is all about getting your original principal back. Liquidity is how fast you can convert that investment back into cold hard cash without taking a massive loss on its value. And returns can be regular current income, like dividends, or capital gains when you finally sell it at a profit. But remember the ultimate trade-off. You can almost never have high safety, high liquidity, and high returns all at exactly the same time. If you want those high returns, you usually have to compromise on safety by taking on a bit more risk.
Just to quickly wrap up this concept, remember that saving is step 1 and investing is step 2. Always weigh your safety, liquidity, and returns. Also, keep in mind a few practical factors for the real world. Pro tip, consider the convenience, your ticket size, which is just the minimum amount required to actually start investing,
and the tax implications. Sometimes an investment looks like it's giving you amazing returns until you realize those earnings are being heavily taxed.
All right, so what actual vehicles do we use to invest? These are our four main asset classes. First up is real estate. This one is highly illiquid with super high transaction costs. I mean, you can't exactly sell half a house if you need some quick cash. Second, we have commodities like gold or silver. They hold global value, sure, but they generate absolutely zero regular income. Third is fixed income, which is essentially debt where you lend your money out in exchange for regular interest. And finally, equity, where you buy shares and literally become a part owner of a real business.
I really want to pause here for a second because this concept is heavily tested. You absolutely must understand the fundamental difference between equity and fixed income. When you buy equity, you are buying risk capital. You become an owner. If the business does incredibly well, you do incredibly well. But if it fails, you lose. On the flip side, when you buy fixed income, like a government bond or a corporate debenture, you simply become a lender. The business promises to pay you back your principal plus interest on a set schedule, regardless of whether they make record profits or barely break even. Bottom line, owners take on more risk, lenders demand more safety.
So, a super fast summary of our asset classes. Real estate is popular, but notoriously hard to sell quickly. Commodities like gold act as safe havens, but won't pay you a monthly rent. Fixed income acts as a portfolio stabilizer. It's safer, but not totally risk-free. And equity, well, while it definitely fluctuates a lot in the short term, historically speaking, it consistently beats inflation over the long run.
Now, speaking of safe investments, let me throw a tricky question at you. Are government bonds 100% risk-free? Think about it. Lots of people just assume that if the government backs it, there is zero risk involved. But the hard reality is, there is literally no such thing as an entirely risk-free investment. Something is always lurking.
See, while government bonds probably won't default on paying back your principal, they are still totally exposed to other invisible enemies. Let's step through the four major risks you need to know. First, liquidity risk. This is when your money is tied up and you can't sell fast enough when a medical emergency hits. Second is credit risk. This is the scary one where the borrower straight up defaults. Third is market risk, like when a global event happens and crashes the entire market. And fourth is interest rate risk, which directly impacts the value of those bonds.
But before we go deeper into bond risks, we have to look at a massive exam trap when it comes to inflation risk. You really need to know the difference between nominal and real rates of return. The nominal rate is that big, shiny number the bank advertises on a billboard, say a 7% return on a fixed deposit. But hey, if inflation is currently running at 8%, your money's actually losing purchasing power. The real rate of return is what you actually get after you subtract inflation. So in this case, 7% minus 8% means your real return is actually a negative 1%. Yikes. Always focus on the real rate.
Okay, now going back to that fourth risk, interest rate risk. This concept is absolutely crucial, so pay close attention. The relationship between overall interest rates in the economy and existing bond prices in the secondary market is strictly inverse. Just say seesaw. It's exactly like a seesaw. If new interest rates rise, the older bonds that are stuck paying a lower fixed rate suddenly become way less attractive, so their price drops. Conversely, if interest rates fall, your old bond that's locked in paying a higher rate looks amazing to everyone else, so its price goes up. Interest rates up, bond prices down. Burn that rule into your memory.
To quickly summarize our whole risk management section here, inflation constantly eats your real returns. Credit risk is all about checking the borrower's actual financial health. Now, definitely note this for the exam. You can reduce firm-specific risk by diversifying, which just means don't put all your eggs in one basket. But market-wide risk, like an economic recession, you really cannot diversify that away entirely because a recession tends to drag down almost all companies at once.
Now, what's really fascinating about investing isn't just the math, it's our own psychology. Behavioral biases are essentially emotional traps we set for ourselves. For example, there's herd mentality, which is blindly buying a stock just because your neighbor or a guy on TV did. Or loss aversion. Did you know the psychological pain of losing 5,000 rupees actually feels much stronger than the joy of gaining 5,000 rupees? This makes investors overly defensive. Or how about recency bias, expecting a soaring bull market to just last forever simply because the last few months were good? The truth is, हमारे emotions are very often our own worst enemy when it comes to wealth building.
So to prevent those pesky emotions from totally ruining the plan, a professional distributor conducts what's called risk profiling. This is a mandatory and highly logical step before you ever recommend any product. You have to ascertain three specific things. The investor's need to take risk in order to achieve their specific goals, their financial ability to take risk based on their current income and timeline, and finally, their psychological willingness to handle wild market ups and downs. A good advisor has to strike a balance here, especially when an investor's super aggressive willingness completely clashes with a very weak financial ability.
Once that profile is done, you decide exactly how to divide the money across equity, debt, and gold. This is your asset allocation, and there are two main approaches you absolutely need to know for the test. Strategic asset allocation is very strict and strictly goal-aligned. If the plan dictates 60% equity and 40% debt based on your long-term goals, you just stick to it. Tactical asset allocation, on the other hand, is dynamic. If a seasoned investor feels equity valuations are extremely attractive right this minute, they might tactically shift their portfolio to 70% equity just to exploit that short-term opportunity.
Let's recap our behavioral and allocation concepts. We know emotions drive irrational decisions. Always profile the need, ability, and willingness to take risk. Strategic allocation is for the long term, while tactical is opportunistic. And remember, when you stick to a strategic allocation, you have to periodically rebalance that portfolio back to its target percentages. Rebalancing is incredibly powerful because it mechanically forces you to do what's right, selling assets that have gone up, so selling high, and buying assets that have dropped, buying low.
Wow. Okay, we've covered financial goals, the silent thief of inflation, asset classes, risks, and even our own human biases. It is a lot to manage, isn't it? Which perfectly brings us to the final conceptual question of this chapter. Do you realistically have the time, the specialized skill, and the total emotional detachment required to do all of this entirely on your own? Or should you outsource it to professionals?
You know, many DIY do-it-yourself investors argue that getting professional help, like using mutual funds, costs money. And hey, they are right, there is a visible fee. But we absolutely must look at the hidden costs of the DIY route. First off, there's a massive loss of personal time spent researching, administering, and constantly tracking investments. Second, and way more dangerously, there's the cost of emotional mistakes, like panic selling during a market crash or blindly buying into a bubble. When you really compare it to the highly transparent, strictly CBI-regulated fees of a mutual fund, the hidden, invisible costs of doing it yourself are often much, much higher.
And that brings us to the very end of our foundational map for Chapter 1. I want to leave you with this. Ask yourself, or rather, ask your future clients, can you truly afford the hidden costs of managing wealth entirely on your own? For the vast majority of everyday investors, the answer is a resounding no. And that is exactly why mutual funds were created in the first place. They are designed to solve this exact problem. In our next explainer, we are going to dive deep into Chapter 2 and see exactly how mutual funds are structured to protect and aggressively grow an investor's wealth. Until then, keep reviewing these concepts, always focus on the why, and happy learning.